Usually when we talk about a financial earnings report, there's this expectation of precision. Like it usually feels like engineering.
Right, yeah. You expect it to be very clean.
Exactly. You get the numbers, the revenue shows a clear upward trend, and the analysts just kind of point and say, yep, there it is, healthy company.
The market definitely loves things to be binary. I mean, a beat or a miss. It's just comforting when a business can be perfectly categorized by a spreadsheet,
Yeah. But then you step into the world of Duolingo's Q1 2026 earnings, which, by the way, we are completely tearing apart today for this deep dive.
Oh, we are digging deep into this one. We've got their recent investor letters, the earnings call transcripts, and a really revealing recent CEO interview.
And when you look at all those sources, suddenly that clean X-ray machine is just completely broken. We're looking at a diagnostic landscape that is, honestly, it's incredibly murky.
Diagnostic muddy waters is actually the perfect way to describe it.
Right. So if you're holding this stock right now, or if you're just thinking about jumping in, you are staring at the ultimate bull versus bear battleground.
Oh, absolutely.
Because on paper, Duolingo just absolutely crushed Wall Street's expectations. Like everything looked incredible.
Completely crushed them.
Yet their stock just plummeted nearly 14% overnight.
Yeah, which is just wild to see.
So we are going to figure out exactly why that happened, what it actually means for your portfolio, and how an army of AI-wielding, vibe-coding employees is basically completely rewriting the company's DNA.
The vibe coding part is going to blow people's minds.
Oh, it's my favorite part. Okay, let's unpack this. Let's start with the numbers that, frankly, should have had champagne corks popping at headquarters.
Yeah, on the surface, if you just read the headline metrics, you would be entirely justified in wondering how the stock didn't jump 20% the next morning.
Totally. Let's lay out these massive Q1 wins because they are staggering. So revenue came in at $292 million. That's a 27% year-over-year increase. It comfortably beat the Wall Street estimate, which was around $289 million.
Right, so that's a solid beat.
Yeah, and earnings per share hit $0.89, which absolutely crushed the C176 estimate. Plus, the people actually using the app every single day.
Plus daily active users.
Exactly, the DAUs. That grew 21% to 56.5 million. And paid subscribers jumped 21% to 12.5 million. Oh, and they're sitting on over $1 billion in cash with zero debt.
Just zero debt. To put that in perspective, that is an incredibly enviable position for literally any tech company right now.
Seriously.
It shows a business that isn't just growing, but is highly profitable. They generated an adjusted EBITDA of $83.4 million just for the quarter, and that's basically their pure operating cash flow before you factor in any accounting tricks or tax structures.
Right, and we should probably point out how they got those 56 million daily users. They didn't just, stumble into that growth.
No, not at all.
Over the last couple of years, they have essentially perfected the psychology of the streak. They've tweaked the app layout so that doing your daily language lesson feels almost as mandatory as brushing your teeth.
Yeah, the gamification is just unmatched.
It really is. So if I'm looking at that financial x-ray, the bones are solid titanium.
Yeah.
But the market just panicked. The stock dropped from over $110 down to around $95 after hours.
Yeah, a massive sell-off.
So why? Why did investors look right past $1 billion in cash and 21% growth?
Well, the thing you have to remember is that Wall Street is a forward-looking machine. They actually don't care much about the money you already made.
Right, they want to know what's next.
Exactly. They care deeply about the money you're going to make tomorrow. So the bear case against Duolingo right now rests entirely on two forward-looking metrics: monthly active users, or MAUs, and bookings.
Okay, let's tackle MAUs first because this number is tricky. They reported 137.8 million monthly active users.
Right, which sounds massive, obviously, but it actually missed Wall Street's expectation of 145 million.
Oh.
And during the earnings call, the CEO, Louis Van Aan, he actually admitted that top-of-funnel user growth is currently, quote, about flat.
Yikes.
Yeah. So you pair that flattening funnel with their bookings guidance, and the panic starts to make a lot more sense. For Q2, they projected bookings growth of only about 6%.
Okay, wait, I need to push back on this. Because if I'm an investor, revenue is actual cash ringing the register today.
Sure, yeah.
So why is Wall Street punishing them so harshly for a slight miss on casual monthly users when the hardcore daily users, the people actually building a habit and pulling out their credit cards, are up 21%.
It does seem a little disconnected at first glance.
It really does. It feels like getting an A+ on your final exam, but your parents grounding you because you didn't join the math club.
That analogy actually captures the frustration perfectly.
Yeah.
I mean, to understand why Wall Street acts like those strict parents, you have to look at the mechanics of how a subscription business is actually valued.
Okay, break that down for me.
What's fascinating here is the fundamental difference between revenue and bookings. Because revenue is backward-looking. It's the money you are officially recognizing right now for subscriptions that people bought in the past.
Right, the money's already in the bank.
Exactly. Bookings, on the other hand, represent forward-looking customer commitments. It's the actual cash collected today for, say, an annual subscription that will be recognized on the books over the next 12 months.
Ah, I see. So the bookings are the pipeline. It's basically the leading indicator.
It's the pipeline that dictates next year's survival. So in growth stocks, if your forward pipeline suddenly drops to mid-single-digit growth, like that 6% projection for Q2, it strongly signals that the revenue engine is going to stall out soon.
Even if revenue looks great today.
Exactly. Now, management tried to explain this away by saying Q2 faces a tough comp because last year they had a massive one-time boost from rolling out pricing changes and a new energy feature.
Right, so last year was just unnaturally high.
Yeah, but the market hates excuses, and it certainly hates seeing growth decelerate to 6%. Add to that the flat monthly active user number. That MAU metric is the very top of the sales funnel.
Because they're the people just casually trying it out.
Right. If fewer new people are casually downloading the app today, that mechanically means fewer people will convert to hardcore daily users tomorrow?
Okay, so the market is looking at a flattening top funnel and slowing forward cash commitments, and they are just hitting the panic button. But here's where it gets really interesting.
Oh, this is the best part.
If you read through the investor letters and the CEO's recent interviews, management isn't oblivious to this deceleration. In fact, they seem to be triggering it on purpose.
They are absolutely doing it consciously. It's a deliberate strategy. They're choosing to sacrifice short-term monetization in order to build a much larger, long-term empire.
I mean, if you know Wall Street is going to brutally punish you for slowing cash flow today, you must have a massive pot of gold at the end of the rainbow to justify it.
You'd have to, yeah.
And for DUOLINGO, that rainbow ends in 2028. The CEO explicitly stated that their medium-term goal is to reach 100 million daily active users by 2028.
That is a staggering number.
Right. But to get there, they have to fundamentally change how they extract money from their users. Because historically, the easiest way to make someone pay for an app is to make the free version slightly annoying.
Right, you add friction.
Exactly. You limit their hearts, you make them wait, you play tons of ads.
You basically give them enough friction that they pay just to make the annoyance stop. But DUOLINGO realized that adding friction to the free tier inherently stifles the massive scale they want.
Yeah, you can't reach 100 million daily users if you keep locking the doors.
Exactly. So they are completely reversing course. They're running aggressive experiments right now, like offering a full 1-month free trial instead of their traditional 7-day trial.
Which is crazy. Giving someone a whole month for free is a huge operational shift. You delay getting their money by 3 weeks, which obviously hurts your quarterly numbers.
Wall Street hates that delay.
But they're way more likely to build a permanent habit and stick around for years.
Yes.
And they aren't just tweaking trials. They are moving highly sophisticated premium features down the pricing ladder.
Like the AI features.
Yes. Take their conversational AI video call feature. Originally, that was locked behind their most expensive premium tier called DUOLINGO Max. But now, they're experimenting with pushing it down to their cheaper super tier.
And the CEO even said they plan to eventually give it away completely for free.
Which is a radical move when you consider the raw compute costs associated with running generative AI video calls. I mean, having millions of users chatting live with an AI tutor requires massive server power.
Oh, the server bills must be astronomical. But it connects directly to their broader strategy.
It's a classic Costco hot dog strategy.
Yes, perfect analogy.
They are practically giving away the premium, incredibly expensive conversational AI for free, or at least very cheap, just to get you in the door. They know that once you're inside their ecosystem, that massive volume of foot traffic will eventually pay off. But my question to you is, how long will institutional investors actually tolerate a company purposely holding back its own money-making levers?
Well, if we connect this to the bigger picture, it requires a lot of patience from investors, obviously, but the logic is sound. In the CEO's interview, he acknowledged making a conscious shift to prioritize audience growth over aggressive monetization.
He knew this was coming.
He explicitly said he talked with his finance team and knew this exact 14% stock drop or, something very similar was going to happen.
He literally knew Wall Street would throw a fit.
He anticipated the fit entirely. But his argument is that in the age of AI platform shifts, user expectations are changing overnight. Very soon, people are going to expect high-quality AI interaction for free across the board.
Right, because everything is getting AI integrated now.
Exactly. And in these massive technological platform shifts, we almost always see a winner-takes-all dynamic. Capturing market share and building a colossal data moat becomes infinitely more valuable than protecting immediate quarterly margins.
That makes total sense.
Yeah, if Duolingo captures 100 million daily users, they just become the undisputed default for global education. Especially when you consider that half of their users are learning English out of absolute economic necessity.
Right, to get jobs, to go to university, not just to, order a croissant on vacation.
Exactly. It's a life-changing skill for them.
And to capture those specific, highly motivated learners, they are completely pivoting how they handle performance marketing. The sources detail a massive push into China.
Yes, the China strategy is huge.
Because historically, Duolingo's free version was so good that paying for ads to acquire users didn't really make financial sense. People would click the ad, use the free app forever, and the company would just lose money on the acquisition.
Right, but organic word-of-mouth growth has a ceiling.
Exactly. And to break through that ceiling, you eventually have to buy users.
You do, but only if the unit economics suddenly make sense.
Right, and now they are getting professional about it. They are finding highly profitable user acquisition in China, specifically for English learners.
Because the motivation there is completely different.
Completely. The lifetime value of a user in China trying to pass an English proficiency exam to literally change their family's economic trajectory. That value is incredibly high. They're very willing to pay for premium subscriptions.
It's a massive market that views the product as an economic stepping stone. When the motivation shifts from a casual hobby to a strict career necessity, your marketing spend yields a much, much higher return.
Okay, so let's summarize the strategy so far. They want 100 million daily users. They are tossing their best premium features into the cheap seats, and they are buying expensive performance ads in Asia.
Sounds like a lot of cash going out the door.
It really sounds like a recipe for setting cash on fire. So to support this massive ambition without going completely bankrupt, Duolingo has had to completely overhaul how they create the actual educational content.
And they are doing it with artificial intelligence.
Yes, this brings us to what I think is the most fascinating and maybe the riskiest part of this entire deep dive.
The sheer scale of what they are executing with AI content generation is truly staggering.
It really is. In Q1 alone, they published 20,500 course units.
Wow.
Just to put that in perspective, that is more than 10 times the volume of content they were shipping per quarter just 2 years ago.
10 times.
10 times. And they have now reached professional proficiency, what's called the B2 level, on the CEFR scale in their top 9 languages. And the CEFR scale is basically the global gold standard for language proficiency.
Right. So hitting B2 means the user can confidently work a professional job in that language.
Exactly. They are churning out high-quality educational content at a pace that a building full of human linguists simply could not match.
Yeah, and the AI goes far beyond just, translating sentences faster. It is allowing them to iterate and A/B test hundreds of different course variations at machine speed.
Oh, wow.
Yeah, they can deploy a new lesson, instantly see which specific introduction to a grammatical concept yields the best retention for a new user, and instantly roll that winning version out globally.
That's insane.
But the most incredible story of how AI is changing their internal culture came from that CEO interview with the Silicon Valley Girl YouTube channel.
Oh my gosh, the vibe coding story.
Yes.
This was mind-blowing. Okay, so Duolingo recently launched a chess course. It's not a language, obviously. It's just learning how to play chess. Now, you would naturally assume they hired a panel of grandmasters and a whole new software engineering team to build a chess engine. Right.
You'd think so.
Wrong. The CEO revealed that the chess course was built by 2 employees who had 0 engineering background and 0 knowledge of how to play chess.
No coding skills, no chess skills, just building a chess app.
None at all. They used AI coding tools, specifically an application called Cursor to Vibe Code, a working prototype of the mobile app in just 6 months.
It's wild.
And the mechanics of how they did this are wild. They didn't just type, make me a chess app into a prompt. They essentially fed the AI an open-source database of millions of chess puzzles.
Oh, that's clever.
Yeah. They used the AI to learn the rules of the game, then guided the AI to generate progressive challenges that teach a beginner how to move the pieces. They architected the logic and curated the output without actually writing the syntax themselves.
Wow.
And today, that chess app has 7 million daily learners and is the fastest growing course in the entire company.
See, this raises a profound question about the future of the modern workforce, because vibe coding is a completely new skill set.
Right.
It refers to someone who doesn't know how to write Python or C++ like a traditional software engineer, but they have the intuition to guide an AI to generate the code by describing the vibe or, the functional architecture of what they want.
So if AI is doing the heavy lifting of dozens of engineers and content creators, like if 2 non-engineers can build a chess app for 7 million people in half a year, isn't this exactly the scenario where a tech company fires half its staff to save money?
You would certainly think so.
Because we see headlines every single day about tech giants doing massive layoffs and explicitly blaming AI efficiencies.
Right. And frankly, Wall Street might actually applaud that move for the immediate margin improvement. But surprisingly, Duolingo has not executed any layoffs.
Wait, not a single one?
Not one. The CEO's management philosophy is just fundamentally different from his peers. He stated very clearly that AI is not going to take your job. Somebody using AI is going to take your job.
Oh, I like that distinction.
Yeah, he believes that an employee using these tools is simply 10 times more productive. From his perspective, if an employee's output suddenly multiplies by 10, you don't fire them to save a base salary. You keep them because the return on investment on that individual just skyrocketed.
Right, you want those 2 vibe coders building the next math course or the next music course.
Exactly, you put them on the next big project.
But wait, running these incredibly powerful AI models isn't free. There has to be a bear side to this AI equation, right?
Oh, there absolutely is. And this is exactly what CFO Gillian Munson warned investors about on the earnings call. While the per-unit cost of generating a single language lesson has plummeted, the aggregate internal AI compute costs are rising incredibly fast.
Because everyone is using it.
Yes. Every time an employee vibe codes a new app feature or millions of users practice live conversation with an AI tutor, there is a hard, unavoidable compute cost paid to server providers like OpenAI or Google.
So the cloud bill is just going through the roof.
Skyrocketing. Management actually admitted that these rising AI compute costs are going to severely compress their profit margins. Their gross margins were a really stellar 73% in Q1, but they guided that by the end of the year, gross margin will drop to roughly 69%.
Wait, a 4 percentage point drop in gross margin for a software company? That's massive.
It is. For Wall Street, it is a giant red flag. It means the underlying cost of delivering the product is getting significantly more expensive, precisely at the time when your forward-looking bookings growth is slowing down to 6%.
Okay, so let's synthesize all of this, because there's a lot here.
There really is.
If you are sitting on this stock, or maybe looking to buy the dip, how do you make sense of this? Let's split the bull versus bear decision.
Good idea.
I'll take the bull side. If I'm a bull, I believe Wall Street is being incredibly short-sighted. I see a company with over $1 billion in cash, 0 debt, and a massive 21% growth in hardcore daily users.
Hard to argue with that balance sheet.
Right. I look at their ability to scale content publishing, over 20,000 units a quarter, combined with that 10x employee productivity through vibe coding, and I see an insurmountable moat.
The AI scale is definitely a massive advantage.
Exactly. So to a bull, the relentless focus on reaching 100 million daily users by 2028 is the exact right strategy. They are smartly sacrificing a little margin today to become an unbeatable, ubiquitous educational monopoly tomorrow.
All right, I'll take the bear case then. If you are a bear, you are staring at that flattening top-of-funnel monthly active user metric, and you are sweating.
Yeah, that flat funnel is scary.
You are deeply worried that the 6% Q2 bookings projection isn't just a tough comparison to last year, but a blaring alarm that the core language market is finally saturating.
Like they've run out of people to teach.
Exactly. And most concerning of all, you look at those massive AI compute costs and worry they will permanently eat into the gross margins without a clear monetization payoff, simply because management is purposely giving away the best features for free.
Man, it really is a massive test of your investment timeline. If you're looking at next quarter or next year.
Right. Patience is key here.
But before we wrap up, there's one final thought I want you to mull over. Something that builds on all this source material, but takes it a step further into the future.
Oh, I like the sound of this.
So Duolingo is currently racing to use AI to teach languages better than a human tutor, right?
Mm-hmm.
They want you to achieve total professional fluency faster than ever before.
Yeah, that is the whole point of pushing that B2 proficiency level globally.
But let's play that out to its logical conclusion. If they aggressively accelerate their users' path to total fluency, and at the exact same time, AI models get so incredibly good at real-time audio translation.
Like built seamlessly into your earbuds.
Exactly. If we have that, are they effectively building an AI system so good that it eventually renders the need to spend years learning a second language entirely obsolete?
Wow. It is the ultimate existential paradox.
Right.
By perfecting the teaching of this skill and simultaneously perfecting the machine translation of the skill, the necessity of the skill itself might vanish.
I mean, think about it. If I can pop in an earpiece and flawlessly negotiate a business deal in Mandarin in real time, why would I spend 4 years tapping my phone to learn it?
You probably wouldn't for business, though I will push back slightly. There is a deep cultural and human connection to speaking a language yourself that an earpiece just can't replicate.
That's a good point.
People will still want to speak to their grandparents in their native tongue, or, fully immerse themselves in a culture without a device between them.
That's true for the hobbyists and the cultural learners. But the CEO himself noted that half their users are learning out of economic necessity.
Right, the career learners.
If that necessity vanishes due to perfect AI translation, their total addressable market shrinks dramatically.
It's an impending collision between human education and machine capability.
It's definitely something to chew on as you watch where this stock goes next. We started this deep dive talking about financial x-rays, right? And how the market wants a clean, binary picture of a healthy or broken company.
Yeah, a simple beat or miss.
But when you look at Duolingo right now, you aren't looking at a static x-ray. You're looking at a live MRI of a company that is actively rewriting its own DNA. The scan might look murky today, but the bones are shifting into something entirely new.
The market almost always punishes uncertainty, but uncertainty is exactly where the biggest technological transformations happen.
Perfectly said. Thanks for joining us on this deep dive. Keep your eyes on those daily active user numbers, watch out for those AI margins, and we'll catch you next time.